Is it? I don't know what I'm seeing. All right, well, thank you guys for joining me for another Passive Investment Flight Club meeting. I'm glad that you guys were able to, for those people in person, I know there's a lot of people joining online as well. So if so, and as through the presentation, if you have questions, please drop it in the chat so that we can make sure we get them answered by our guest speaker today. I'm excited actually to be speaking or for this meeting because really we've really been in a space for the last probably year and a half where multifamily has been really tough ground, and a lot of that is we know interest rates have gone up, and so that's caused you to be able to understand the dynamics of financing and understanding how to really be able to take down your deal. The details are really extremely important now. Yes. Where maybe 2 years ago, we had like a sweet space where it was just crazy appreciation, and so a lot of people got away with probably a lot of things. And so I have somebody who's been in the game for 20 plus years. He comes referred from people that I am in a community of syndication and multifamily with as well. So I'm excited to bring him up shortly. But before that, for those who it's their first meeting, we got one new person that I see today. I am Tari Thomas. I've been investing in real estate for about 20 plus years, well, now I want to say 20 plus years, now I'm going to be dating myself. About 20 years or so, on and off, really started in the single family home space, and then in 2020, got into the multifamily space, and I started by buying small multifamilies, going through a bank, which some people will do that with the residential side. I ended up going through the bank side because I was a self-employed individual, so we can talk about that a little bit too, on the pros and cons and what type of financing to use depending on the type of deal that you want to be able to take down. And so now, once I discovered syndication, which was in 2022, just a year ago, I've been just kind of rolling and learning, and because I saw the absence of people that looked like me in the space, I really wanted to start bringing it and educating it to business professionals and investors that I knew in the area that were in the single family space, to show them the benefit of multifamily and how you can accelerate that cash flow by doing it together as a group investment. So I will advance my slide here. Can you see that? Oh, yep. No, not that one. So our vision, really plainly and simply, is to create a community of investors who are like-minded, that understand the power of our collective capital, whether that means you guys are JVing deals together. I'm specifically talk a lot about syndication, which is something that's more regulated. If you're doing a JV, there's strategy for that, and I'll probably have someone to come in and talk about the strategies of doing it with just a small group of partners. But my goal is to really have everybody really understanding what they have at their fingertips and the power we have collectively to be able to take down large commercial assets. Specifically, I talk about multifamily, but my goal is that eventually, we can talk about self-storage and we can talk about some other asset classes, but don't ever want to overwhelm people, because, it's good to focus on one area when you're starting out. And so our mission really is through exposure, getting you around like-minded investors and individuals, getting you around experts like Larry, and being able to make sure that you're tapping into education. We're just talking about a conference that a lot of you guys went to earlier this year, so making sure that you're educating yourself so that when the opportunities come, you're ready to pull the trigger. And I know some people in the room, some people have learned a lot along the way. We're working on like small multifamily deals and different types of deals, and so understanding the details are so critically important. And multifamily, there's great opportunities, but I always tell people, if you don't buy right, you'll be in pain. Just because you own large assets doesn't mean you're making money at it. So, there's a lot of people in the multifamily space that are making capital calls. They're in tight spaces. They over leverage themselves, 80% or over. And so they're in spaces where they're tight, and because interest rates are so high, they got into bridge loans and things like that. So we're going to talk about all of that, because that is important for you to know, not only if you want to be on the active side, but also if you want to be on the passive side. If you want to be on the active side, you can still go through a local bank and do multifamily and take it down that way, and there's strategies for that versus a residential financing. I know a lot of people will use residential financing if it's 1 to 4 units, but you can use commercial financing for it as well. So we can talk about that. But then on the syndication side, if you're doing deals passively, you still want to know kind of what is the financing. You want to be able to be intelligent enough, as we always talk about, to be able to ask questions. And so we'll have Larry up, and if they have bank financing, there's 2 different types of financing. I'll talk to that a little bit. You're either going through a mortgage broker or you'll be going with a bank. Yep. And there's agency, which is your Fannie Mae, Freddie Mac, HUD, that type of financing. There's whole separate rules to that versus a bank. Bank does their own underwriting, it's their own rules. So when you're dealing with the agencies, they got a certain amount of structure and they're not breaking it for nobody. So so that's why I really felt the need to have someone from the local bank space, and I say local banks or regional banks because they're smaller, they can do different things than kind of your large, Chases and things like that. So I'm about to get started here, but I wanted to just show one other slide. We talked about the syndication structure. I won't talk to this too much, maybe a little bit for one new person in the room. Ooh. Oh, there we go. So there's 2 sides to this. When we talk about syndication, we're talking about group investing, coming together. It's secured from an SEC standpoint. And there's many ways to go about it. I won't dive too deep into that, but there's the general partnership side. They're the ones that are the active group. They're the ones managing the deal. They're the ones finding the deal. They're the ones managing the assets. And then there's the LP side. And I do believe that it's important, even if you're an LP, that you really want to understand the deal, understand the terms of the deal because that's why a lot of limited partners are in the space that they're in now, where they're getting capital calls because maybe they didn't understand all the details of what the financing looked like. And now that they're in hot water, it's not a great space. So, but what I really wanted to show is this bench. And these bench players are critical. We've had a lot of these bench players in, and we'll continue in the new year to bring some of these bench players in because it's really important to understand how they play a role on the team. Jody is back there, but she's the property management. That's the building that we're sitting in here. So we thank her for just allowing us to have this space. CalCap is awesome. They're also partners with a lot of people that are in the syndication multifamily space out here in Arizona. But I'm circling right now the mortgage broker and the banking space because they're a critical part of your team. And based upon how you want to take this asset down is when you're kind of determining, okay, which direction am I going to go? And so now I can introduce Larry Moyer, who has been in the game for quite some time. He's now with Alaris.
I see, now you've exposed my age. Thank you. No, just kidding.
So he's a senior business advisor, and I personally know a lot of the loans that he's helped people within the multifamily space take down. But he's going to come up here and just, we'll have Q&A. So as you have questions, feel free to ask him. But he's going to take us through some of the things that he looks for. Yeah. So if you're looking at, you want to know, okay, what criteria do I need to have? What are the things I should be building up and being ready so that when that deal comes, I'm ready to take that down. So if y'all can welcome with me Larry Moyer.
Absolutely. Thank you so much. And can you guys hear me? Yeah. Okay, perfect. And Terry, we talked about, when we were talking earlier today, we talked about using someone as an example. You're it. Well, I really wanted to kind of talk it from sort of a local perspective, but I also wanted to talk about it. If you're just one individual, you have some interest and you're going to buy a multifamily property and you're going to a bank, the types of questions and things will happen. So I thought of you because how you went in, you got your first property, you dealt with the bank. And so I'm going to pretty much take them through the process that you went through when you got your first property.
Yep.
And I'm sure you dealt with a loan officer, and there were questions and things that they wanted. So I'm really, so
Yeah.
you're the puppet.
No problem.
Yeah. So, so what I wanted to do is just really talk about, what you go through, and so what banks ask for when. So you at this point you've identified a property that you're interested in purchasing or acquiring, and then you've gone into a bank and you want to, you talk to a lot of times what you'll find, and this is kind of how it works in the industry, like Terry talked about. It's having the bench. So a lot of times you're going to be working with a real estate agent or a real estate broker, and a lot of times they're the ones that, to be honest with you, how I get my business a lot of times is from real estate brokers,
Yep.
real estate agents. So you're going to identify a property, and they're going to say, hey, I've known Larry Moyer for X number of years. Hey, why don't you talk to him? And then that real estate agent a lot of times is going to be a part of that bench. And they're going to provide a lot of the information to the bank as far as what you need to get that loan done.
Yep.
And so a lot of times, where you really find the real estate agents and the brokers helpful is they've worked with me before, they've worked with the bank before, and they know our process.
Yeah.
And they can really guide you through that process. So having that real estate agent as a part of your bench or the broker is fantastic because
Yep.
they've dealt with the bank before and they know triggers here and there, they know red flags, all the things that banks look for. But just like Terry said, I've been in the industry for 20 years and I know the Phoenix market pretty well, and I used to work in the DC market as well. And real estate's very regional, so what happens and what works here doesn't necessarily work in the DC area. And even when you get into Phoenix, what works, in Scottsdale doesn't necessarily work in Avondale or Goodyear. So real estate's very regional. So, that's why it's really important that you're familiar with, if you're purchasing a property, you're familiar with what's going on in that area.
Yep.
So it's very regional. All right, and I wanted to start out about when you initially find that property, I wanted to talk about qualifying factors or things that are going to that you'll need in order to qualify for that loan. So a couple of things so every time I do a deal, like with a lot of your residential mortgages, half the time you don't meet the agent, the agent doesn't go see the property. But on the commercial side, it's a different game. I mean, we want to meet you. We absolutely want to see that property. So the first thing that we're looking at when we look at that property, and of course these are things that you should also be doing as an owner, is the condition of the property. How old is the property? Is it, if the property was built in 1980, there's going to be there could be some issues. So you're going to want to find out what does the roof look like. So that's what we look at, property conditions. Is there deferred maintenance? Has the parking lot been replaced recently? What about the HVAC? So these are things that, as a bank, when I'm a lender as a bank, so the appraiser is going to talk about it, but my job is to really kind of get in there and really take a look at that property. Is there anything that, if I'm telling the bank that we should finance this property, is there anything that the bank needs to know about that property? So I'm usually taking a look at, I usually we'll look at 20% of the units. Is there anything, what's going on with those units? What's the condition of those units? A lot of these older property buildings will have a chiller or one main, source of heat or air there. So I'm going to look at the condition of that chiller. Now, part of your plan may be when you're buying that property is to do some renovations and all that, and then that certainly will be addressed with a different type of loan. But I'm looking at the condition of that property. I'm looking at the location of that property, because that property could be located in an area where the bank hasn't done a lot of financing or we're not as familiar with that area. So I'm looking at the location and see where that property is located. Are there any issues with that location? So it's my job as the lender to really sort of be the eyes in the area and ears of that bank. So that's the first thing that I'm looking at. The other thing that I'm looking at is the sponsor. So, so that could be you as an individual or it could be collectively as a group. So I'm looking at that sponsor's experience.
Before you jump to the sponsor side, on the property condition and location, I know, just coming from the IMN conference, that now from an insurance standpoint, anything under the 1980s and that's in like maybe a C or less, is starting to get dinged a little bit from an insurance standpoint because insurances have increased all across the board. is there any spaces where, from a bank standpoint, that's coming into play at all?
Yeah, so what I would say this, so it depends on, a lot of the properties that I see from 1980s, a lot of them will have undergone a lot of renovations. So some of the renovations that may have been recent could have addressed some of those issues. So it depends, but usually if it's an older property and there really hasn't been a lot of stuff done that's over the years, yeah, that absolutely could be an issue. But what I have found, most of the deals that I've done, there's been some form of renovations. So I'm going to really I'm going to get information. Has the roof been recently replaced?
Right.
What about the electrical? To try to address, because in my mindset, 1980, I've got some thoughts that are going through my mind.
Are there red flags there from an underwriting standpoint that people should look out for? Like that would be like it'll get them a denial from a loan standpoint?
I would say if there's issues with say for instance you've got a roof that hasn't been repaired, yeah, that could certainly be an issue. A lot of times it depends on the size of the deal, we'll ask for a property inspection. Because that inspector will go out there and they will identify any potential issues. So there's been times, I'll give you a perfect example. I did a property down in Mesa, 16 units, and so there was an inspection that was done, and the inspector did say that, hey, the roof is in fair condition. However, over the next several years, there's going to be some repairs. So the one stipulation that we put in the loan documents is to set a maintenance reserve for the roof. And then, so that maintenance reserve, instead of saying, we could have just said replace the roof, but we said, hey, do a maintenance reserve. You're gonna take X number of dollars out of your income that you're getting on this property, put this in a restricted account from the bank. When it's time to do the repairs, then the repairs are going to be done. They'll be advanced from those restricted funds. We'll get the invoices from the contractor they're using. So that's an underwriting thing that comes into play.
And so I think that's really good to understand is there is an account that you will have to set up
Yes.
to be able to hold these reserves.
Yes.
Because that is something that the bank is going to be checking on to make sure that you're following through. So that's always good to know as well when you're passively investing in a deal, to know what is the capital reserves. That's a question I just asked, a few syndicators at the deal that I was looking at, is to look at what those capital reserves are, or if there's any requirements from the bank on.
And usually it's a restricted account, and then again, as those repairs are needed, we're getting the invoices and bids from the contractors you're using, and then we'll release those funds as we get it. So that way we're sort of managing and making sure that work is being done.
Yep.
So that's an underwriting thing. So what will happen is we'll approve the loan, but it'll be contingent upon these things happening.
Got it.
All right, perfect. So good question. Yeah.
Question for you.
Yes.
On the location portion of it, so if you mentioned it's not something that you've typically funded a particular area before, and
Yeah.
you might have to do a little bit of due diligence around that. Like, what does that look like, especially if the area is in transition? What kind of
Well, and see, that's the thing. So you could have some areas in Phoenix or in any city that's in transition. So the bank will find out, because we get lists of foreclosures and things like that. So there's a certain area where there's a high volume of that. Yeah, that could be a concern. But then, what happens is, there could be renovation work where it's a sort of a renovation or reposition where you're aiming at a different clientele. Because I'll give you a perfect example. So the light rail area in this area. So I would say, 10, 12 years ago, not so much. But the area has definitely changed, and I've done many deals in that area for years. But it happens when I work with a lot, I've got a lot of people in the bank that sit on that ivory tower and they don't come down for that. That's where it's my job to really kind of go out there, tell them about the area. This area is in transition. So a lot of my write-up that I will do, I will address those potential problems. So, because you're right, someone from that's in that ivory tower may say, well, hey, what about that area? So that's where it's really my job to get out there, get that information, and mitigate that potential risk for the bank. Yep. So,
and just to tap on that a little bit, and I'm gonna let you go on.
No problem.
Is I think that's the beauty of having that relationship early with the bank, right? Because if you're just a random person that's coming in, you may not be incentivized to go do all of that, and you might be a different person than another bank, right?
Yeah.
So having that relationship, even the banks that I've gone through, they know me. Like, so it's
Yeah.
like, hey, I'm considering this deal, throwing it over, running the number. Can you give me some numbers? What is?
Exactly. You've got that really, and you know what? No, really, I hate to use the dating example, but I'm going to use the dating example. It's like that first date, you're on your best behavior. But then as you get more comfortable, and that's the same thing with the bank, because I've got customers that I've worked with, and at the end of the day, they say, I've got this property, and I'm like, oh yeah, let's get this. I mean, I'm going to go. And the bank is comfortable. And again, it's that second, third date, and now you can eat the burger,
Yep. Yeah.
So you're just feeling more comfortable.
That's
so it's,
funny.
it's that same process. So so there are banks, like, even when it comes to location. So Arizona is our area. That's primarily our area, and that's where we feel comfortable. But if I've got a customer that I've worked with for many years, and loans have always performed well, I may go to New Mexico. I may go to Colorado. I may go to California, which is generally out of our market. But because I have got faith in you as your customer, and you've got a track record of success, yeah. So we'll go to that location. So that's the other thing that I mean by location. But we're also looking, like you said, experience. So if you're buying a multifamily property and it's 30 units, the other thing I'm going to look at is, have you owned a 30 unit property in the past? What kind of real estate investment experience? Because there's, or say, for instance, you just moved here last year from Boston. You haven't really, you're not that familiar with the whole local economy. You could also be using a property management, and that's great, but we consider someone from that sponsor team that's kind of boots on the ground, that's familiar with the area, and they know the area well. So that's another thing that we look at in terms of experience, that, how long have you lived in the area? Have you managed or have you purchased a similar property like that in the past? Because if you have, you're gonna know what if there's an issue with evictions, or if there's legal issues that could come up. Even though you're going to be doing some of that through the property management company, but you may have a situation where you may be managing that property on your own. So you're going to absolutely need to be familiar with those issues. So that's where that sponsor experience. So if you've had 3 or 4 properties, that's really helpful, and I would certainly factor that into the experience side.
And I think, just to add on to what you're saying, is you see that as your sponsor team industry experience. So this is where the partnership, and once again, recognizing the collaborative power is. As an example, for me, I'm new to the syndication space, but I have sponsors and I have people who have more experience than me, so that's critically important when we're taking down something that's extremely large. That's going to go a long way. Otherwise, by myself, I couldn't really do it.
And that's where we were talking about this earlier today, strength in numbers.
Yep.
And if we've got a sponsor team where you've got 5 or 6 people, we are looking at everyone collectively. Because I will tell you, there's been deals where there's been weak links within those sponsors, but I really look at everyone collectively. So strength in numbers is for sure. But I wanted to kind of use today as an example. I'm talking about Terry with her first property, just to kind of give you that perspective, because you're going to have syndication groups. You're going to have these syndication groups. You're going to be working, as you guys get more successful, you're going to grow, and you're going to be in those syndications, those larger deals. But I wanted to kind of give you a starting point.
Yeah.
This is your first deal. You're getting out there. But having that experience of so that's why we were talking earlier today. Sometimes it's okay to get that residential loan, to get that fourplex. Because anything that's less than 5 units, that would be considered residential. So this is a way you can qualify, get a standard residential mortgage. The underwriting for that is different. If you've got W-2 income, they'll factor that in, and that could qualify you. But by the time that you come back to me, for a commercial loan, then I've seen that at least you've had some experience with the multifamily property, so that's helpful. So when you're thinking about your point of entry, I mean, sometimes you don't want to come from not having anything and then jumping to a 50-unit property. I mean, that's a big jump. So, I would pick your points as far as how you want to enter. So that sponsor team experience is important. Property financials. So if you're buying a property, you want to see how has that property performed over the years. So sometimes the sellers have them, sometimes they don't. But property financials are really important, because you're going to know, like, hey, if I buy this property, am I going to make any money? So what is the property's history? you know? And so to me, I would sometimes, I would get a little leery. Like, so when you bought your first property, did the owner provide you, the current owner, or at the time the seller provide you with any financials?
They did, but when
Yeah.
you're buying, one was really clean because
Yeah.
it was an agent-owned property,
Okay, there you
right?
go. That's great.
The other one was trash.
Exactly.
Right?
So I'm going to take a look at those, but at least if they can give you some type of financials as far as how the property is performed, you know. And again, sometimes, you know, you're dealing with these mom and pop sellers, so, you know, they may have it on the Schedule D of their tax return, but I would say this, Schedule E, I meant to say, but. So if they keep QuickBooks, or if they keep any kind of financial information, it would help. So
when you
financials.
don't have those financials, and obviously, you know, there's cases where you don't.
Yeah, that's
and
true.
so you're projecting either the future,
Absolutely.
you're trying to get an understanding of the current state, are the tenants paying on time, and trying to piece together the pieces to put into a financial model so that you can say, is this even advantageous for the operator or for the person who's going to be
That's
owning
where
it?
the real estate agent can help, because a lot of time when I work with real estate agent and broker, there's a lot of those guys, they have teams of people that will put that information together for the bank.
Now, is there any property financials or projections, like the vacancy being under 90%, or, you know, is there any numbers that you're specifically looking for to make sure that you can close this deal?
Well, you know, so that's the thing. So we'll absolutely look at vacancies. We're looking at projections, because a lot of times when we get, you know, when our folks are buying these properties, a lot of times the rents are not at market rates. So that's where we become dependent on those projections, and we want to know the process, you know, that they're going to go through to get the market, because there's a stabilization period. Mm-hmm. So that's what we're going to look at. So if there's improvements that they're doing, whatever they're doing to get those rates to where they're going to be, that's where the projections are going to be really important, and then we're going to need to know the story behind those projections. And I'm going to be talking about projections just a little bit later.
Okay.
So that's where the projections are really important. Because a lot of times, but you're right, especially on some of these smaller properties, the seller, what you get from the seller, there's not going to be enough. Sometimes the brokers or the agents will have them, but you're right, if you're dealing with a seller that's owned the property for 30 years, then most of them do not keep good records. And that's where the projections are really going to be important. And sometimes some of them are just horrible property managers. You know, they haven't been getting the rents, bills haven't been paid on time, so you'd be amazed. But that's where you have to kind of go into that mindset, knowing that, you know what, this property is really not performing that well. And then you've got to have a plan as far as what you're going to do. And
I see that as opportunity. For me, I see it as, hey, it's an opportunity to really maximize areas where they didn't.
That's exactly right. So it's, you know, so you need to be someone like Terry, have that vision to know, like, yeah, but that's what I want you to tell me, Larry. I know when you get this, the financials are not going to look great, but I've got a plan, you know, and I'm going to want to know about that plan. And then, you know, as I'm going through and evaluating that plan, is it realistic? And that's where we're going to really kind of get into those projections and all that. So property financials. The next thing is down payment. Typically, when you're buying a multifamily property and you're obtaining a commercial loan, and even a residential, a lot of times too, that down payment's typically going to, at a minimum of 25%. So even if you're doing a residential loan and you're getting a fourplex, a lot of these mortgage providers still will want a 25% down payment. There's some cases where you can get away with less. But, you know, for the most part, the maximum fine, I mean, the minimum that they're going to want is that 25. The maximum that you're.
They just changed
minimum.
the rule
recently.
I think Fannie Mae, where if you are owner 1 to 4 units, you only have to put 5% down. Now, what situation?
Is that on the Fannie Mae side? Wow.
Yeah, it's just recent. It just goes.
Okay, wow.
I think it just went live in like November.
Yeah.
But I don't know too many deals where you can put 5% down and the numbers work. So
and the thing that
like,
worries me about that, because I don't want to get back to 2005, 2007, where they were doing that, and then you know what happened after that.
Right. No,
So banks, they learned a lot, but usually it's going to be in that 25% range. And, you know, and if that doesn't work, I may, you know, even if you're coming to me and you're saying, hey, you know, can you do 75% financing? I'm going to look at the financials that you've either gotten from the seller or your projections to see if that works, because I may come back and say, hey, well, based on what I see here, you're going to need to put down at least 30, 35%. It just depends. But I will certainly let you know that early on in the game. The thing, yes.
So I got a couple of questions for you. So, I'm sure you know that on the. So the question is on the residential side.
Yeah.
To qualify is based upon someone's income.
Absolutely.
But on the commercial side is the performance of the property.
Absolutely.
So my question is, are LLCs or entities able to get credit or get a loan on a commercial side, or does it still have to be an individual that's applying?
Oh, no. If you're buying a property and you're obtaining a commercial loan, to be honest with you, we'll finance it either way.
Okay.
We can do it in your name, or we can, if you decide that you will. It's riskier to do it in your name, because then if you own that property in your name and someone falls on the steps or whatever, they can go after you personally, where having that LLC would certainly give you some protections. But the bank, if you want to buy a property in your name and not form an LLC, we're okay with that.
Right.
Yeah.
And so as far as the financials go, is it trailing 6 months or trailing 12 months? Or how
Yeah,
do you guys look
and
at
that's where having the agent, sometimes they will help you put together a trailing 12. We typically like to look at a trailing 12 for sure. So that would be another thing. But again, sometimes on some of these smaller purchases, they don't even have that. But yeah, if you had a trailing 12 to let us know how that property is performing in the last 12 months, that's great.
Yeah.
That's certainly, and a lot of times we find that still the performance may not be enough to do the loan, but still it kind of gives us sort of a starting point of where we are.
Gotcha.
Yeah, but trailing 12, it's great.
And just for clarification, so people understand what trailing 12, 'cause I'm
Yes,
sure somebody
that
doesn't
is
know what
true.
trailing 12 months is. Do you want to?
Yeah, absolutely. So trailing 12, so it depends on the point that you buy. So say, for instance, you're buying this property in August of last year. So that trailing 12, usually it goes back from July, all the way back, July the month before, all the way back to September of the previous year. So we can, because and the reason why that trailing 12 really becomes, so it gives you a breakdown of the profit and loss statement for each month. And so what may happen is you could be, that previous owner could have been in the middle of renovations or is a stabilization for that property. That trailing 12 will tell you where the rents are going and where the expenses are going over that 12-month period. So it really becomes important, especially if you have a property that's in transition.
Sorry, one more question. So you mentioned when folks are repositioning. So the next question is when folks are mentioning they're going to reposition the property
Yes.
and they want to increase rents, where do you look for to see what kind of tolerance a particular property will take in terms of rent increase, where it makes sense, in areas where the increase you're projecting doesn't make sense for the zip code area?
And that's where you have to, and I'm going to talk about this later on too, but that's where the property, if you really know and the agent, they should be able to provide you with property comps. And so the real estate agent should be able to give you sales comps as well as rent comps, because you're going to be using those numbers to come up with your projections. So a good real estate agent should be able to provide you with that information, because that's something that I'm going to say. We'll certainly have an appraisal, and appraisal will sort of validate that information. But if you're working with a commercial real estate agent, they should be able to provide you with those comps. And it should be sales comps and rent comps. And they should be, and I'll go a little bit deeper, but they should be able to provide you as-is comps, renovated comps, as stabilized comps. A good commercial real estate agent should be able to provide you with that information.
We got a property manager.
Absolutely
Yeah.
right. And I'm going to piggyback off some of that for you, because
Yeah.
I'm going to answer some of that. So first of all, I'm Jody Waitbright, once again, with the property management. We are a multifamily property manager. So my team will come in, and just to say what you're asking there, we look at all those T12s. We pull everything. So we do an underwriting. Our brokers will send us the OM if it's on the market, correct? We'll pull everything. We look at all the financials. We look at for your marketing. If you're going in and you're going to put an LOI in on anything, our team will go out and walk with the brokers. We look at everything. My regionals, we pull out our vendors to look at any kind of piping that you might have. If we need to do those lines, if we do need to do any of the HVAC, like you said, chillers, we look at everything from the roofing to the flooring to any of that. Am I here? There you go. He always has to correct me on that. And so what I am just trying to say is we will always always help you with your banker, mortgage broker, or anyone to show you what that underwriting looks like and bring you those projections of expenses as you do that throughout all that. So,
Well, and that's great. That goes back to Terry talking about your bench. So the property manager is part of that bench. So it just depends. That there are times that we, in fact, a lot of the folks that I've worked with, your company has been able to provide a lot of that information that we need, and that's great. But a lot of times they don't have exposure to that. But if you have a solid bench, and then also like you guys have done a lot of inspections for some of the properties that I've worked at.
Inspections, and we normally do 75 units and above,
Yeah.
right? But we do have the off-market that we will help with any of our owners or partners
Yep.
that want to look at something demographically, if it's situated next, what the rents are going to be. We'll look at every situation and pull that for you, just to make sure you're sitting in the right spot, what's happening in that property. And so we do that not only through Arizona, but we're in 7 different states. So thank you for that. I just had to piggyback. 'Cause
I think
you
that's
have a
great because it
thing.
comes back to that
Yeah.
bench. It comes back to if you've got a good bench or you've got a good agent, a good property manager, they're going to make your job a lot easier because as a bank, I'm going to ask you for all this stuff. So if you've got a good property management company, because I've looked through CalCap's and all their
No, they're
information,
great.
and they're fantastic.
They're great as well.
Yeah, they're fantastic. And so it's going to make your job, having that strong bench absolutely will help.
And I love that you're spanning the range, because anything in that small multifamily standpoint, you're probably not going to have a CalCap,
Yeah,
right, or property
exactly.
management team. So your agent should be helping you get
agent should
rental
be doing
comps
that,
and,
yeah.
and helping you get to some of that,
Hey,
that
make them
information.
earn that commission.
Yeah, hey, at the end of the day.
They should absolutely have it. All right, so we were talking about the down payment. So the other thing that we're going to be looking at, secondary sources of payment, because we're looking at, because a lot of these smaller deals, or deals where you're working with banks, the owners or the folks that are on the sponsor team, the bank is going to require them to guarantee. So we're going to be looking at that as a sort of a secondary source of repayment. So we'll typically ask for typically a personal financial statement. We also will ask for tax returns because we look at everything sort of globally, because the primary source of repayment is, of course, is the rents. But for us, it's like, if that doesn't work out, do we have a secondary way to get out of this deal? And so we will certainly be asking for financial statements. A couple other things that we look at is when we're working with sponsors, we look at the liquidity of the owners, because you could have a situation where you're doing a construction loan and there's delays, all kinds of things where it's going to take your loan longer. So that, and you may have to, or you could have even cost overruns. And so that's where the liquidity of the owners come into play, because it's like, if this happens, do you have the additional money that may be needed to get the project done? Or you could have an apartment building, you got 30 units, and everyone stops paying rent all of a sudden. I've never seen that before, but it could happen. So does the sponsor team, on a collective basis, do they have the liquidity to
What's
kind of work
your
through
typical?
that?
So that's a great question, or a great segue,
Yeah.
I guess, into this question of what is the typical liquidity? And this is
Excellent
once
question.
again for larger deals too,
Yes.
that you're just passively investing in. Understanding what the bank's looking for from that general partnership or sponsor team, but what is the liquidity?
That's a perfect question.
Yeah, that
we
they-
typically like to see it anywhere between 20 and 30% of the loan amount.
Okay, so 20 to 30% of the loan amount,
the loan
they should
amount,
have
yeah.
that liquid in some sort of space.
Exactly, and it's collectively. Yeah, so
Yep.
we look at it, everyone
Across the
collectively
team.
across the team. Yeah, so it's interesting because we don't like to get into like 401ks and all that, or retirement, but we'll look at cash, stocks, anything that we consider liquid. Retirement, we look at it, but we typically don't like to go after retirement, and we kind of discount that. But stocks, bonds, all that, other investments, yeah. So, and then again, we're looking at the liquid number, because what we see with a lot of real estate investors usually is they have tons of real estate, but not a lot of cash.
Exactly.
Yeah, I'm worth $11 million, but then to get the cash from that, there's a transition of where you got to sell those properties.
Absolutely.
So we are definitely looking at cash that you have in banks, and that could be between personal and business accounts. So what you'll find in some of these loans, from an underwriting standpoint, you may find that if we approve that loan, there's a liquidity covenant that's in there. That says that, hey, when we look at this, because we do annual reviews, so when we look at this next year, is on a collective basis, does the team have a liquidity amount that's 30% of the loan amount? So,
With that transitioning with covenants, so foreclosures, I'm gonna go back to the hard part. How do you get on that list, the preferred investor list? So when you're going in and say, hey, we're gonna have, these covenants haven't been met this year, we're gonna foreclose on these properties. We need to call these people to take over.
it's interesting. You see that a lot on the residential side, not as much on the commercial side, because, and the reason why, it's kind of a private thing. We don't even like to kind of put it out there that that's happening.
For like the preferred,
Yeah.
preferred investor list, where you're not gonna advertise,
Yeah,
you
yeah.
just start calling out investors.
It's amazing. You know who actually knows? The agents know. It's not something the banks kind of put out there, but the agents know. So they are, I would say, they are your best source. And
Not the bank itself.
not the bank itself, because it's something. Yeah, because everything, we have our own portfolios. Because I'll give you a perfect example. We have customers where there's problem loans, and we may not even tell them that your loan has a problem, but you'll know. But there's certain monitoring that we do, but we keep it very much internal. We're very tight-lipped about it. Yeah. Yeah.
How about HELOC, Larry? You mentioned staying away from IRAs and things like that. What about HELOCs?
Okay, so HELOC is so that's that extra. But it's not liquid, because you still have to. There's a conversion process that you go for that. But we're really looking at cash, and then invest, because if it's a stock investment, you can liquidate that pretty quickly. And so those are the two top things that we're looking at. I will say we'll look at your retirement, but it's not something that's kind of a last resort for us. But it's usually cash and stocks. And there could be, we also will look at the surrender value of your life insurance. So you could have a face value that's at $1 million, but if the cash surrender value is $100,000, we'll consider that. So anything that you can liquidate quickly to pay off that loan, that's what so that's what we're looking at. So those are things that when we're looking at the sponsor team and we're looking at the individuals on that sponsor team. So, I hate to use Terry again, but I know you went through this whole process when you're getting the loan. So that is some of the initial things. And as you can see, Terry, having a strong bench can help you provide the bank with a lot of that information. Any other questions about that? All right, so this is now, we're getting to, I'm going to talk about projections, but I wanted to talk about the step before the projections. And so this is where your real estate agent or the property management firm, they will provide you, a lot of information. So we've got two types of comps that you want. So for the property in that area that you're in. So you want to know about rent comps. You also want to know about sales comps. So for similar properties in the area, and I talked about valuation area, we typically like to keep it within a 3-mile range because, again, real estate is regional.
Right.
It's very regional. So what's going on in Scottsdale is not necessarily what's going on in Goodyear. So we like to try to keep it in that tight knit. So that way we know that the properties that we're looking at in that area, they're similar properties. So 3 miles. Well, some go off 5 miles, but we typically like to keep it within 3 miles. But rent comps, there's a couple ways that we look at rent comps. So as is sort of what the rent comps are right now. So as the property is, when you acquire the property, you haven't done anything with it, you haven't raised any rents, it's those current rates. So you will see a lot, when you're getting comps, you're getting comps on similar properties that are in a similar condition as your property. Same thing about renovated rent. So if you've got properties in your area that have been recently renovated, then we're also looking at those similar properties and the rental rates that they're getting for properties. And usually it's renovated, I would say, within a year or 2 years. And then stabilized rents. So you may have a situation where you may not be doing any renovation work, but you may be in transition to where you're raising the rent on that property, which could, a lot of times when you're trying to get it stabilized to the market, that could take a year. So we're looking at, similar properties, that have gone through that transition where the rates have been raised. And so we're looking at at those stabilized rents. Most of the time, that will usually follow a renovation. Where you go in there, because I've seen, like, one of the first deals that I did, it was in an area of Phoenix where, before they did the renovation, they were getting like $650, for like 800 square feet. They put about $25,000 into the renovation work. They got that done. They were able, right after the renovation was done, that went from 600 to 1,000, and then they really worked for another year to get it up to the stabilized rents, and then that was eventually at 1,300. So it's a process. That whole process can take about 18 months. So you're taking your rents as they are, after the renovations, and then really kind of getting them up to the market of the stabilized market rents after that. That whole process can take about 18 months. But so that this tells us how it is now. This tells us after the renovation work has been done. The same thing on the sales side. So, so when we get an appraisal, the appraiser is going to give us, they're going to give us an as-completed appraisal, an as-is appraisal, what the property is like now, an as-completed appraisal after the renovation work has been done, and then after those rents have been stabilized at those rates, they're also good. So I usually will ask for an appraisal with these three values on it. So, but again, a lot of times when you're working with this, if you've got a good property management firm like CalCap, or you've got a strong real estate agent, they should be able to provide you with that information. We will confirm, because we're going to, we have banks, most banks and most agency firms as well, they will have a group of approved appraisers that they deal with that will be able to give them an appraisal based on these parameters. But again, a good real estate agent, good property management firm, they should be able to provide you that. And I have found most of the time, especially when I've worked with CalCap, they've been right on the money with the appraisal. So,
And just a reminder that those rents are so critical just because of that net operating income.
Yeah.
As you're entering into the commercial space, it's not so much based upon what the sales value is from a residential
right.
standpoint, but more so what the rents are. So.
Absolutely. So I just wanted to kind of go. So this is the step that you want to go before you're starting to do your projections. This will help you determine with your projections. So you've got gross rents. So gross rents. So if you know that in 18 months, where your stabilized rents are, if you're pretty confident in those numbers, then you can do your gross rents based on the number of units and the stabilized rents where you think it will be. So that's really where that number is coming from. So that's your gross rents, projected. And I will ask you, well, hey, how did you come up with that number? And that's where you can tell me, well, hey, based on the information that we have, this is where our stabilized rents will be per unit on an annual basis, and then that will help us. So that's really where that number should come from. So that's your gross rents number. So then you've got RUBS. Are you guys familiar? I know you're familiar with RUBS. But really, so that is when, with a lot of your older Phoenix properties, you've got your chillers, and you've got the one energy source. So a lot of property managers and owners, so what happens is the owner is the one that's paying that utility expense. So what they do, how they recoup that, is they subdivide that amongst the tenants. But it really depends on the square footage of the unit. So it's divided among that. So if you've got a 600 square foot unit versus someone that has an 800 square, so the RUBS that you're paying the owner may be a little bit different from, you're going to pay more if you've got more square footage. So it's actually divided, so they're basically taking the total square footage of the building, and they're subdividing that within the tenants based on the amount of space they have. So that's a space that is an expense that the owner is recouping, because they're paying SRP, they're paying all those bills, and then they're recouping that expense through something that's called RUBS.
What is that acronym stand for?
Yeah, it's
like
I always
utility
forget
bill
that.
back or something like that.
It's like, yeah. And in fact, I wrote it down here. Just hold it just for a second, because I'm so used to asking about it. And
Utility bill back
Yeah.
system.
yeah, ratio utility billing system. Yeah, exactly.
And so we do that on most of ours. It's like we have included within your rent.
Absolutely.
Your RUBS is going to be water, sewer,
Yeah, exactly.
right? And then they just pick up, and sometimes internet. but it depends on the property, and then they pick up.
Yeah, and so that's a reimbursement that you're getting from the tenant.
Yeah, I was just making up things in my mind.
That can be variable. Yeah.
Square footage, I don't have.
Usually you set a flat amount.
Yeah.
And then you just charge it.
Yeah.
And then you can change it year upon year as the leases come due.
And then now sometimes on some properties, some of the newer properties where the tenants are paying their own expenses, you won't see that on
won't
there.
even have it.
Yeah, exactly. But the older buildings, yeah, that's a common expense that you'll see. Other income. So the owner could be charging for pet. There could be administrative fees. So that's other income that they get. So that can really vary in terms of what that is. But put that on there. A vacancy factor. So, definitely when you're doing your projections, because again, there's going to be some vacancies, but the numbers that we typically like to see are within 5-10%. So, and so if you don't put it on your projections, I'm going to put it on there for you. I will certainly factor that in because there's vacancies, So, but 5 to 10% is the realistic number that you want to see. That's what you'll see for the area. Now, at the end of the day, you may not have have any vacancies at all, but it's still a conservative way of, because there's always what ifs.
Yep.
That could happen. But 5 to 10% is the number. And, most real estate agents would try to slip in 4%, all that, but it should be between 5 and 10%. And the bank will accept 5 for sure.
And it's come down, right? Like, so the vacancy, it's really specific on the area as well, because Phoenix was 97 for 98 for probably many years, and now it's kind of down in the low 90s somewhere.
I will tell you, I remember in 2010, 2009, it was 77, 79.
Right.
It was, this area's come a long way. So definitely put that in there. And sometimes we'll do even a stress test where, we'll do a stress test of the loan that the vacancies go down to 65%. Will that be sufficient? It's a stress test that we do internally.
Yeah, it's like a break even.
It's a
Like
break-even
where does
number.
this property, at what vacancy level does this property break even where
Exactly.
it's,
Exactly.
So as an owner, like, I always need to keep my vacancy levels above X, Y, and Z.
It's a stress test you
Yeah.
want to put on there, the worst case scenario, because it's standard against that 5-10%, but I would say as an owner, stress test it, because you just don't know what may happen, and at least like if I get to this point, I can at least cover my mortgage.
Yep.
So that's on there. All right, so economic loss, what that is, it can be a number of factors, but like say for instance, if the market rate for that property is $1,500 per unit, but you're getting $1,200 per unit, that's considered a loss. A concession is in that category. Concession meaning that if you say for instance you're renting the property and you said, hey, I'll give you a $200 break per month for the first 6 months. That's a loss that you're getting on that. If there's bad debt, where your tenant's behind with making the payments and all that, those are all considered economic loss. It's usually an allowance for that is usually 1% of gross rents. Yeah, so that's what economic loss means. And then from there, you're going to get your effective gross income. So other expenses that you see on there, property management, and she knows about, but usually what we see, it's anywhere from 3 to 6% of gross rents. Would you agree with that? Yeah, so that's the number that we typically see. Yeah, number of units, yep. Property taxes. And so when you're doing research on that, you can easily go to the Maricopa County Assessor site and find out what the property tax is on that annually. Insurance, get an insurance agent, because we're looking for realistic, we want to make sure when we're looking at those projections, I'm going to ask you, where'd you get these numbers from? So you should be able to tell me when you're putting these projections how you got the numbers. Insurance, replacement reserves. So there's going to be maintenance stuff that you have to do. So you should set aside, when you're doing your numbers, it's usually $150 to $250 per unit. Sometimes it's even higher, but put that aside for, there's going to be things that break down in the apartment that you're going to have to get, that you'll have to get fixed as the owner. So factor that reserve, but it's usually $150 to $350. That's kind of the range that I've seen per unit. Factor that in. Some banks, as you're underwriting the loan, there's sometimes that we will actually have you replace or put that reserve in the bank. So when it happens, you'll be able to say, well, hey, I got a fixed X number of units. We will want to see the invoices that this work was done, and then we'll fund it.
So quick question, because I know for the banks that I use, because we were in the smaller unit category, they were looking at, they did these projections and they used kind of a swag,
Yeah.
probably like a 60% or 40% or whatever
Yeah.
is the expense. They did like a ratio.
Yeah, and you typically see 30%. That's kind of the number. What I typically like to do is I like to break it down.
Yeah, no,
But
understood.
sometimes some people will they'll do the projection, they'll just put that 30% in there. But it depends on the bank that you're working for. Some of them really want to see these numbers broken out. But 30%'s the 30
And then
40.
do you take into account the debt service coverage ratio? Are you looking at?
Absolutely.
Yeah.
So to get into that, so here, once you get your total expenses, you're getting your net operating income. So typically, what we want to see, that debt service coverage, your net operating income should be 1.25 times the annual loan amount. So that's kind of the comparable number that most banks. And with multifamily, we've actually had a little better. It's 120. But so that your net operating income should be 1.2 times the annual debt service for that loan. That is that in fact, I get real estate agents all the time. What's your debt service coverage requirement? But that number is kind of the standard number, especially for multifamily. When you get into, I will say it varies per industry, per sector. If you're dealing with like a special purpose property, like a church or self-storage, it's higher. And the reason why is that those marketing those properties, turning those around, it takes longer. So it's a higher number. But for multifamily, 1.25 is your number. Any questions about the projections? But this kind of gives you, and I would think that most of the time as you grow, you're going to have people on your team, either on your team, your real estate agent, your property manager, they're going to be able to help you put that information together. All righty. All right, so then this is and I'm not going to get too deep into this, but these are some of the loan options. So, a bridge loan, it's sort of like a short-term loan. So a lot of times you're buying a property and what you want to do is you don't want to go through the whole process of going through your standard bank loan. So sometimes a bridge loan, and the same thing as a hard money loan, it's a loan to where you're not going to go through the same type of process that you would go through a bank. The interest rate's going to be a heck of a lot higher, but you can go in there, do any renovation work that you do, or stabilize the property. It's a short-term loan. It's usually 1 to 3 years. After you've got that bridge loan done, even if it's tied to construction, then you can go back to a bank and get more longer-term financing. But it's a short-term loan for 1 to 3 years. If you're going to do some renovation work, if you're going to stabilize the rents, if you feel like, hey, if I get in there, before I take it to a bank and get a long-term deal, because what you may find is that, right now I'm not going to be able to get financing at these rents. Get a bridge loan, because again, they're not looking at the same thing that banks are looking for. You're going to pay a lot more on the interest rate, but it's a short-term solution to go in there, get that property, either do some renovation work or stabilize the rents, get them up to where they should be, and then come back to a person like me to get more of a longer-term deal.
So you guys do both, right?
We do both.
The strategy you see people using bridge loan on, can you give an example?
Yes. So what I see is if someone's going to go in there and they're just going to, so they may just do a short-term loan. It's construction loan and bridge loan. They could be the same thing.
Yeah.
Where they're going in there, they're just going to do the construction work for 1 year. They're going to have it done in 1 year. They may come back to us for the longer-term loan, but this is a loan that we're more relationship, so we don't like to do the bridge loans, but we will do it for existing clients that we have a relationship with.
Roll the bridge loan into long-term?
Exactly. In fact, that's where we're going to talk about that mini firm loan. So it'll roll in there. So what may happen, though, is you may find one person goes to a bank or a hard money lender, get the bridge loan, do what they need to do, and then go to another bank and get the longer-term loan. Or there are a lot of banks out there in some capital funding sources, they just do bridge loans. That's all they do. And that you're in there for that short term, 1 to 3 years, and then you're done. And they're going to tell you, well, hey, when you're done, call my friend Larry for the longer term loan.
And so in my case, for the property that I took down in a fourplex,
Yeah.
in order to be competitive, take it down quicker, and because of all the rehab,
Yeah.
it wasn't a bridge loan, but it was a hard money loan.
Yeah.
And then we refied out of it within 30 to 45 days so that we're not,
I've seen that. That's
in that
even
space.
shorter. Sometimes I'll see where it's done in 60 days. But
Yep.
and again, you want to make sure you get it done because you're
don't wanna be paying on that.
You don't want to be paying on that, and your rate can go up exponentially after the 60 days. So you want to make sure that you got a plan to go in there, do what you need to do, and then start the whole process for the longer term financing as you're doing that bridge loan. So that way, all of it kind of.
And I would
happens
say
together.
baking your risk,
Yes,
right? Like
yes.
a lot of people will look at the terms and not say, oh, here's the money I will have to pay for,
Yeah.
paying the service on that.
Absolutely, I mean, because it's expensive money. But I find a lot of investors, they want to kind of go in there, get control, because the normal bank financing process, it could take 30 to 60 days, and some of them don't want to wait that long. So this kind of goes in there, they get control of that property, and then they're still talking to the bank for the longer term loan, but this bridge financing is getting there, letting them go in there, get that property, get things set up, come back to us for the bank financing.
Right, can I say one more
Yeah.
thing? I'm sorry. So on that, to piggyback you.
Yeah.
When you are doing your analysis, would you like me to be on that? When you are doing your analysis, whether it's through your property management, it's important to let them know what kind of loan you're going after.
Absolutely.
Because we need to know when we're doing that, if you want a full year expense budget for what that's going to look like, because we're going to break it down just like you did in your whole, and that was fantastic.
Thank you.
And so we do break it all the way down we go really deep for you. And so it's very important to know because we need to know what your rate is. When is that going to expire?
Yes.
Do we have 6 months? When do we need to get those lease ups? What are you looking for? So great point that you're making. It's very important to
That's
to
good,
know
but
that.
then this really comes back to what Tara, I'm going to steal a lot of things you said earlier today. The bench, it is so important. If you've got a strong bench where you've got good contractors, good property management firm, good broker that you're working with, they're going to help you get that bank loan. Yeah.
Does the bank look at you a little bit different if you're refinancing the loan versus you're acquiring the property? Is it?
Not really, because it could be a cash flow savings, and especially like if you've been in a hard money loan for like the last year and you're paying 13% and now the bank rate at 7.5%, that's going to be a cash flow savings for sure. Yeah, so
It's a little bit easier to finance a loan if you're refinancing versus your.
if we know the purpose and we understand what you're doing, yes.
Okay.
Yeah, and because we have to understand this is the situation that I'm in. If I refinance it, and this is the reason why I did it, if I refinance it, it's going to result in this. Yeah. So it's all about just being transparent, giving that story, and making sure that you communicate. Yep.
And I'll ask one more question, because
Yes.
I know with agency loans, your Fannie Mae, your Freddie Mac, your HUD,
Yeah.
they have seasoning requirements.
Yes.
Meaning you have to hold it so long of a time period before
Right.
you can refinance it.
Absolutely.
Does the bank,
And so that's where you've got your prepayment penalties that are in there. And we will negotiate that. It's all about making sure when we do that loan that we understand up front what your whole purpose is. So if we know that you're not going to have that loan long period, that's something that we need to discuss up front.
Yeah.
So I may, what I may do is lower the prepayment, make it a 0.5%, knowing that at the end of the day, there's going to be a cost to get out of this loan, but it just won't be as bad.
Yeah.
But that's where communicating and so that term sheet, I love the term sheet. I'm sure you've seen many of them, but that's a discussion tool. That is, because I go through every aspect of that loan when I'm doing the term sheet. So really, of course, when you sign the loan documents, there's a lot of legal mumbo jumbo that's in there, but that term sheet tells you everything that you need to know about.
I like
the
that you
loan.
say it's a conversation, because
Yeah.
a lot of people will say, well, it's frigid. It's frigid at this
Oh
number.
no, it's a
but-
conversation.
Yeah.
Yeah, because I've worked with some of the folks that you've worked with in the past, and they go, "Well, you can do a little bit on that, can you take this down a little bit, And so I really call it's a discussion tool. It's a discussion tool, but at least you have an idea initially what that loan. And so there's some battles I can win. There's some that I'll come back and say, "Hey, I talked to the bank, and we can't change it." But but at least before, because at that point, we haven't done the formal underwriting yet. At this point, you may even do it before you sign the actual purchase contract. But at least up front how that loan is going to be structured. Because so typically, I don't need a purchase contract. If you're saying that you're going to buy this property, give me all that information. I'll come back and tell you. And then that may, and once you get that, you'll say, okay, well, now I feel now that I know what the loan's going to look like, I feel comfortable with purchasing the property. And then one thing that I'll need is the final purchase contract. Because, again, when you see those terms, they're all contingent upon certain things happening.
For sure, absolutely.
Yeah, so it's not, I always tell people, it's not an approval. It's just, it's a discussion.
Yeah. We have a question online.
Okay.
Somebody asked how much is a rate cap, but I think that's dependent.
Yeah, that is
Yeah,
definitely.
absolutely
Yeah, and it was interesting, and banks are not doing that as much because of what's been going on with the rates.
Got it.
Yeah, we used to do it all the time, but
Got
you're
it.
not seeing that as much. Hopefully, because from what I'm hearing, that rates, we should see a 1%, maybe 1.5% drop over the next year. I'm hoping.
We're all hoping.
They were all hoping, absolutely.
But it's going to be harder once that happens to get in. So
It's going to be harder to get in
Yep.
because then you're going to see more people out there.
For
so
sure.
The next 12 months are going to be very interesting. So construction loan, I won't go too much into construction loans, but construction loan, I'm really talking about ground up construction. So because I work on multifamily deals, I don't know if you've done one of those, Terry, where the bank will finance the actual ground up construction of a multifamily property, and that's where those projections become important. But then there's other factors that we look at that point because we're looking at the contract that you're working with. We're looking at that contractor budget. Is there contingency in that budget? Sometimes you'll get an interest reserve, meaning that the interest payments that you make over the time of that loan will actually factor that into the loan. It'll be budgeted into the loan. So those payments are actually being made by the bank through your loan proceeds. You see that in a lot of construction loans. And the reason why is when you're doing a construction loan, you're working with a property that's not income producing. So that interest reserve is built in there to pay for that loan during that time. Again, the other thing I was going to talk about is I just lost the contingency. There should definitely be a contingency between 5-8%. Make sure that's built into your budget. Now, at the end of the day, we may not even have to use that, but you know about prices going up, supply chain issues, all those things in there. So definitely build. We're going to be looking at that contractor, and I know you guys do some construction and contracting as well. So we're going to be looking at that budget to make sure that contingency is built in there. But again, having that strong bench, they will be able to help you put together that budget, put together those projections and all that for the construction loan. The mini-perm, that's typically, I would say this, most commercial loans are similarly structured to your residential auto loans. They're usually anywhere from 3 to 7 years. And what we try to do is they usually encompass the lease. Now, in this case, with multifamily, most of your leases are 1 year. But if it's a different type of property, like say if it's a retail space or corporate office, those leases can run 3 to 5 years. So we typically try to put the term of that loan around the lease, with the exception of multifamily properties. But again, it's usually 3 to 5 years. The actual payment, even though it's 3 to 5 years, the actual payment is based on, with multifamily, we can go up to 30 years. The actual payment is based on a 25 or 30-year loan. So it has some similarities to a residential loan, but then the rate is fixed for that 3 to 7 year period. The term is over after 7 years. So I'm sure in your mind you're saying, well, what happens after that 5, 7 years? We actually go through a renewal process. So that doesn't mean that we're coming to call the loan at that time. We will go through a renewal process. We may want to do an appraisal after 5 years. Certainly will be an inspection of the property. But there's underwriting that we do, and if everything is where it should be, we would renew it for another 3 to 7 years. But it's called a renewal process. It's something that we do internally through the bank, and then we reset everything. So, but it's not that we're coming in and we're asking, okay, 5 years up, pay off your loan.
So there's a little more on that. So we're hearing quite a bit about a number of syndicators underwrote, assuming none of them is high of a rate that we have now, in which case they're in a situation where a liquidity issue.
Yeah.
And they're doing capital calls. So so is that loan, so am I hearing that correctly, that the payment is still a 30-year loan, but every, let's say 5 years, an example.
Yeah, exactly.
So does that reset the loan, or is that,
So we stick on that amortization schedule.
Yeah,
So even though, it's a 30-year amortization, so when we reset it after that 5 years, we're still in that 30-year amortization schedule. So so if you look at an amortization chart over 30 years, after 5 years and that rate is fixed, we're now in year 6.
Okay,
After the reset, yes, because we want to make sure. Now, the only thing that may change is that you don't know where rates are going to be
Sure.
at that time. But yeah, but we're at year 6 after the reset.
And at that time, you can either bring more capital to the table. Or
Yeah.
You can, okay. I've been hearing some potential amending the loans at that time because of people are in this liquidity crunch. Are you seeing any of that at this time?
We're not seeing that much, I mean, but we're bracing because banks are tightened up for sure, but there's potential for that to happen. I haven't seen a lot of it lately.
Okay.
2007, 2008, oh yeah.
Gotcha.
Yeah, there was a lot of it.
So, and the last one, so I've been seeing some, I never think I can quite understand on it. It's a shorter term product. But there's a balloon aspect to it. Can you spin that a little bit?
Well, yeah, it's interesting. So, so if you looked at your loan documents on your standard commercial loan, you'll see where it says, after year 5, that, X number of dollars. So it looks like a balloon loan. But really, what it's not, we're actually we really go through a renewal process with you. So the loan, so even though so the bank has the ability, because it's a term loan. So the bank, if they wanted to, if we feel like we're having troubles, we could collect that whole thing after 5 years. So that where that balloon aspect is in there. But typically we go through a renewal.
So typically, so even on the private side, if they use the word balloon, that means they want 100% of that paid off.
On the you seriously a lot on the residential side. On commercial, yeah, but we go through a renewal. Because I get a lot of people that are especially entering this for the first time, like, you want me to pay off in 5 years? Like, no, if everything's going, because I'm sure, have you been to that stage where you've been at 5 years? And a lot of times with the multifamily properties, they're not really, by 5 years, a lot of times they've been sold or something's happened, but I've definitely done my share of renewals over the years. And again, if everything's going the way it should be, the bank will absolutely, and then we usually will even inform you 6 months before that, say, hey, the renewal's coming up, let's start getting the financial information and all that. So we try to get all that set before that day comes up, because we may get close to it and we're getting the numbers and it's like, I don't know if that's going to necessarily work out, but we certainly don't wait till the last minute for sure. Any other questions? So your mini terms, again, very, very similar to your residential RM loans, very similar. It's got some similarities.
Does your bank ever take a second position?
We'll take, I'll tell you, we'll take a second position behind one of our loans, but just like Terry said, no. The answer is usually no. But there are, I will tell you this, if it's one of our loans, we'll do it. But if it's like, if you come to us and you've already got a lender ahead of us, it's very rare. You see them sometimes with SBA loans. I don't know if you've been involved in that space. Sometimes the SBA will sometimes go second. So it just depends. On your standard commercial loan, no.
And that's good to know, because I know there's a lot of people are looking at assuming mortgages.
Yeah.
And so because of all of that equity growth, you might assume a mortgage, but it's only like 40% of the value of the property, right?
That's right, yeah.
So,
When you're taking assumable on that.
for sure. Yeah, trying to understand where do you come up with the difference and what bank is going to
That's
do
right.
it.
And you see that assume on some of the agency loans, but on a standard bank loan, usually that doesn't happen. Have you been a part of where you've assumed a loan?
No, but I've seen others that have assumed a loan, but it's a question on who might take a second position for that large amount, which may be 50% of the cost of the property.
That's
So
true. Any other questions? Nope, I think we're good. So the last thing I just wanted to get into, and again, so the bank, even though you're going to have your real estate agents, your property management firms, they're going to be providing you with comps. But at the end of the day, the banks, they're going to do their own appraisal, and we will certainly, we have approved appraisers that we work with. And there, occasionally, if you've done, say for instance, the seller did an appraisal 2 months ago, we'll sometimes look at that appraisal, but it just depends. There's a high threshold that they're going to have to meet, but we typically like to use our own appraisers. There's a certain process that we take them through before they get on that list. But there's a couple of appraisals. We talked about this earlier. As-is appraisal is the property as it is today, if you're spending, $700,000 to improve the property, we want the as completed value once the property is approved. And this is where your amortization could be set because, say for instance you're doing a property where you've replaced, the HVAC, the electrical, heating, all that good stuff. That could really add to the useful life of the property. So the thing that I'm looking at is something that's called remaining useful life, and that's within the appraisal. So the appraiser may say, well, if this work is completed as they say it's going to be completed, that will add an additional 30 years on the property. So if I give you a 30-year amortization, but the appraiser comes back to me and they say that, if this work is done the way it's going to be, the remaining useful life is 20 years, that's the number that I have to go with. As stabilized, so that stabilized rents over the next year to 18 months. And then the way that most banks, and I would say almost all of them, they do loans based on not loan to value, but it's the lower of either the acquisition price or appraised value. But it's whichever is lower. You'll see that on a lot of your term sheets. But most of the time it's on that loan to cost. But occasionally I've had appraisals come in lower. But so we're going with that lower value.
Got it. Where are the scenarios where you'll see the appraiser value come in lower than the cost?
And a lot of it has to do with the appraiser goes in there and they find a lot of additional damage that I may have missed even as a lender, or the seller didn't tell the buyer, or the work that they're doing is really not going to take it to that value. I've had a couple deals like that have fallen through because of that. And because sometimes, that old saying, lipstick on a pig.
For sure,
Because
absolutely.
you'll see that where they will go in there, and some of these guys think they can go in there, spend $5,000 on doing this and that, and they think the property's going to be valued. No. And again, also too with the real estate agent, they're going to try to put the best space on it because they want to sell. But that's where the appraiser goes in there,
For sure.
and they're giving us the most objective opinion on that property. And that's why we really put them to the ringer to make sure that we're getting an unemotional, independent opinion about that property. And so it happens occasionally. It does.
In your opinion, go ahead. Somebody asked a
If
question.
it comes in lower, can you still negotiate to see if the seller will take the lower?
Yeah, you could. Yeah. But most of the time, the sellers are not. But occasionally, that has happened. But I'll come back to you once I get it, because I usually will get it. We have a review team that reviews that appraisal just to make sure if the appraiser has determined that it's worth less than the sales price, but they're making sure that the appraiser, that they have the right accreditation, they've done the right analysis and all that. So even before I call you, we will have gone through all of those steps to make sure. And then I will come back to you and say, well, hey, if you can get the seller to lower again, that may or may not happen, but and say that I can do the loan based on this scenario from the appraisal.
And I've had to challenge when I did the take it down hard and then refied out with a commercial loan.
Yeah.
I had to challenge the appraisal because it was a regentrifying neighborhood.
Yeah.
And the comps for the rents across the way. So I had to do some additional legwork just to make sure that they were able to evaluate the property based on the rents of where the property was going. And so because a property nearby, that's why it's sometimes good to see some stabilized or rehabbed properties that are somewhere in that kind of 3-mile radius that you talked about. Because if not, then it's kind of hard for banks to make that assessment.
And Terry, you bring up a good point, because sometimes, even though most of the time we will go with the appraisal, but if you can come up with some good arguments and good evidence of showing why we should go with that. Yeah.
And I had to get the leases,
Yeah,
right? Say, hey,
exactly.
owner, and it was literally across the way, same square footage, same, layout, everything.
Yeah.
Just say, hey, love to get your
And you got
leases,
the
and we
leases,
can
so there you go.
Yep, and we can provide
There
that.
you go. So
Yep.
so you're right. There is, I would say, this probably happens 10% of the time, but there's a possibility. It can happen.
We do the same thing.
Yeah.
I think you know that. We will jump the neighborhood over because
Yeah.
there's a new one sitting here, but over here is really gonna make a difference because this is where that comp's sitting in that submarket, right?
Yeah.
So we do that as
And
well.
that's why we have that internal appraisal department, because we really scrutinize their work,
Yeah.
just to make sure that. Because you could see there's some cases where I've seen where some of some of their work where the property was a lower value that should have been higher.
Right.
So we have that. That's where we have that additional step that we take with the internal review, just to make sure that their work was done in the right way. And so we're also dealing with, because appraisers also have certain specialties. So we're not going to use an appraiser that works with mainly industrial properties to do a multifamily property. So we're really trying to make sure that that we're being completely fair with everything.
Do you ever do a second opinion appraisal?
You know what? We've done that with the borrower, but the borrower, that's going to be additional payment that they, yeah. And then that appraiser, there's certain requirements that they're going to have to meet, but occasionally, but sometimes what borrowers will do, you know what, if you're not going to do it, I will go with another bank, and what we will do sometimes, what I've seen where if they're just not happy with what we're going to do, there's been times where I've seen borrowers, they actually can, what they can do is you can have that appraisal be accepted by another bank. There's a whole process that you have to go through by that. Yeah, so that happens on occasion.
Okay.
Yep. Well, I hope this was some good stuff. Last thing, a couple of things, and I just won't go into it, but we talked about prepayment penalties. Most traditional banks, we do what's referred to as a step-down prepayment penalty, meaning that, if you pay and it's usually applying to the refinance. Sometimes it'll apply to the sale, but mainly to the refinance, which means that if you refinance in the first year of the loan, most banks will charge 3% of whatever the outstanding principal balance is. Then it steps down to 2%, then it steps down to 1%. Some banks will continue that on, but that's your standard prepayment language with a commercial loan. We were talking about some of the agency money. They will do a yield maintenance prepayment penalty, which can really hurt you in a declining interest rate environment. But that means that if you're paying off that loan in a declining interest rate environment, there's a whole calculation they go through that, but it could be costly.
And that's bank versus agency, which is anytime we say agency, it's Fannie Mae, Freddie Mac.
Exactly, Freddie Mac. Yeah, that's right. Bank is your standard step down. There are some banks that will occasionally use yield maintenance, but I would say 99% of them use the step down. So that's where those term sheets, the language, it's upfront. You pretty much know what you're getting into. That yield maintenance, but again, you're dealing, well, especially with the agency money, you're dealing with more sophisticated borrowers, so they're willing to take that risk. Loan covenants, we talked about, so we look at financial statements on an annual basis. So if there's a covenant of debt service coverage, 1.25 that we talked about, we're going to look at, a year from the time we've done the loan to see if that ratio is being met. However, if you're doing like a renovation, a repositioning, usually it's 1 year after that property's been renovated or stabilized. So if it's going to take 12 months to renovate, an additional 4 months to stabilize, then we'll measure that 1 year after that time. Because we want the property to be stabilized, the work to be completed, get it stabilized, and then we're looking at the numbers a year after that.
Yeah, I think we spend most of the time on the sell side, but I want to on the buy side, right? What are the folks in the ivory towers doing? So the first question I kind of have there is your source of liquidity from deposits only, or is it from the Federal Reserve? Where are you guys getting your liquidity?
It's mainly from deposits.
Really?
With banks, yeah.
Okay.
Definitely. So banks are we're doing everything, all banks in general, they're trying to get, because the more money they get in deposits, the more they can lend, because they have reserve requirements.
Got it. And is that cheaper money than the Fed's money?
It depends on the type of money. So if we have the money in just a business checking account, and we're not paying any interest on that, that's cheap money.
Okay.
But if we've got the money in money markets and CDs, that's when it becomes expensive. And so rates have been going up over the last several years. So that's kind of depressed some of the banks because they've had to pay out a lot more money to get those deposits.
So the other question is, how do you identify like a bank that's looking like clean up their balance sheet and sell some of their notes?
I will tell you this: it is a rarity on the commercial side that you will see a bank selling their notes. We keep everything. Now, what we do sometimes, we will participate notes, but we don't sell them most of the time. So that means if say for instance, if I'm doing like a $10 million loan, because that's a big loan for the bank, what I will do is find a participant bank that I could get together with, and we will do the loan together. It's usually seamless for most of the borrowers, which means that you're still dealing with me as the bank. However, I have found another bank, sometimes in North Dakota, that will get on that loan. We do all the underwriting. We send that package to them. They do the final approval, but it's seamless. So sometimes to reduce our risk, or if the bank is having a liquidity issue, that's where that participant bank will come into play, because that means that we don't have to use all of our money.
A few times you mentioned that there's some spots where reserves have to be kept within the bank.
Right.
If the syndicator can't like fill those reserves, do you open it up to others to kind of, to come in as?
Well, I will tell you, so that's what the whole syndication thing. So usually when we're doing a loan that's a part of a syndication, what happens is, even though we're looking at the syndication and how that's structured, usually there is a general partner group within that syndication. There are either key partners, general partners. So a lot of our underwriting really is surrounding that general partner group, because they're taking on the responsibility of that loan.
So that's the only place you go find?
That is the place that we're looking at.
Like say, open it up to others and say, look,
No. In fact, what you'll see when you're, so again, because the other folks that are on there, they're kind of the passive folks, they have maybe 1%, 2%, but it's that general partnership group within the syndication that we're looking at. But you remember, they're also getting like a syndication fee and all that stuff. So, they're earning their keep for sure. But they're generally responsible for the loan, the property management, dealing with the banks.
Is there a net worth requirement on that side of the network?
Well, usually I would tell you this. So when you're involved in a syndication, there's a net worth requirement. And what I have found most of the time, it's $1 million. Yeah. Any questions?
To your next topic, the loan covenant.
Oh, yes.
So if
Sorry.
if the borrower's in technical default, how long do you guys allow them to work it out before you foreclose? Like if you're in technical default because of a loan covenant.
It's interesting. So it depends. Like a lot of times, for the most part, the way the way it's written, if you're past that 10 days late, the bank could really collect. Now, does that really happen? No. But sometimes we'll deal with attorney-prepared loans where the attorney will write that, and it's where you're dealing with the banks. Well, the attorney will say, give my client, it's called a cure period. And so give them 30 days to get it together. And so, but that's all negotiated.
They make the payment, but more maybe they have the ratio, the debt service ratio is off now, or
I will say it's negotiated, but that's where the
net worth is down.
So the loan documents, the way the loan documents are written, it's hard standard language.
10 days after.
Yeah, but that is where you negotiate and you talk, because we don't want to liquidate the
How
property.
often are you guys verifying loan covenants, technical?
Typically annually, but it depends on the complexity of the loan. If it's a $10 million, $20 loan, there's construction, there's stabilization hurdles and all that. We may verify quarterly.
Okay.
So it just depends, but most of the time it's annually. Okay, so I got through that. Debt yield, that's another, and I'll talk about that later on, but usually debt yield, what we're doing is we're taking the NOI of that property and we're dividing that by the loan amount. It's just another performance metric that we're looking at when we're doing loans. And it can sometimes, for multifamily properties, we like to see that between 8 and 10%. But if it's lower than that, there could be some additional exposures that you don't see on debt service coverage or your LTV. That's another measure. A lot of banks don't use that, but some banks will put that metric in there. Tangible net worth that we look at. So tangible net worth, when we're looking at guarantors especially, and they may put that in the loan covenants, meaning that we're looking at things that are liquid. So so to give you an example, say for instance you're looking at a company and they've got a lot of equipment, or they've got goodwill, they've got patents, all those things on their balance sheet. Well, the banks, we look at what we can sell on the courthouse steps. And so that's really what we're looking at. So I hate to say that. So I was talking, with a lot of your companies, you'll see where on their balance sheet they have patents, goodwill.
I'm saying the parts that is easily liquidated on a quarter steps.
I would say the easily liquidated things, especially on a personal financial statement, your cash, stock, with retirement, that may take some time to liquidate, but you could also liquidate that. If you've got a lot of equity in your home, so we kind of look at it in sort of in order if we have to liquidate. But if we give you a personal tangible net worth, it's almost like the equivalent of a liquidity covenant, meaning that you've got to have that net worth of the X number of dollars. I haven't seen that lately, but that is a covenant sometimes that you'll see in loans.
I've never seen like those instruments in a sheriff's sale. Like I've never seen.
Yeah, where you really see it is on when you're dealing. If I'm dealing with like an owner-occupied loan, like a doctor or a lawyer, there's a lot of stuff that they have on their balance sheet that it's actual value, but it doesn't have liquidation value.
Right.
So that's kind of the difference.
So then where do they go?
Well, what we do is that we won't. In fact, we sometimes will identify that early in the process as we're doing the loan, and we take out all those assets because they're useless. I hate to say that, but they are. So usually I will have had a discussion with you about that in the early stages of the loan.
So we're talking about loans that are not non-recourse.
Yeah, exactly. Sometimes not non-recourse, but again, most of the loans that you're doing with the bank there is recourse involved.
Yep. All right, so I know we're coming down to the tail end.
And then
but-
annual reporting, just tax returns, financial statements. We're going to make sure that insurance policy's been renewed. That it also may involve a collateral inspection. I may go out to the property just to make sure that things haven't changed. I mean, I'll tell you, I'll sometimes go out to a property, there's no tenants.
Yeah.
It's things like that's happen.
Wow.
You would be surprised.
Wow.
But that's why on an annual basis, we're just making sure that property looks the same way that it looked when we did the loan.
Right, there's no red flags that
There's
are
no red
coming up.
flags. Yep. That's it. Sorry, hopefully I didn't go too far over.
No. That was
I think
really,
we've had a
really
good
good
conversation.
information. Yeah.
Thank you.
Absolutely.
Appreciate it.
Any other questions that people have? Real quick,
Yeah.
if you had to, 30 seconds, why somebody would go bank versus agency, what would you say?
I would say, especially if you're starting up, again, use you as an example. I think at this point, going with a local bank, developing a relationship of your own, if you've got one partner, that's probably a more straightforward way of doing it. I think as you develop and you get into these larger groups, that's where the agency money comes into place. But I think right now, especially, again, I know you're bigger than that, but from where Terry used to be. Yeah, but that's going with the bank and getting that local relationship with your bank. Because also, that could even affect the rates. Because if we know you're going to have, if there's other things that we can get, like deposits, there's chance to do personal mortgages, other types of things, that can help on the pricing. You usually don't see that with agency money because they're doing the loan.
Right. So I see, how I translate it, more flexibility from a bank standpoint, right?
absolutely.
More negotiable.
Relationships.
Agency is agency.
Yeah.
If you don't meet it, it ain't happening.
Exactly. That is the best way to put it.
And there's good side, there's goods, there's pros and cons
Exactly.
to
Because
either
sometimes,
side.
I've seen some of the agency money, they'll give you up to 80%, it just depends. So there's things, but there's good and bad. It just depends on where you go. But I would say what happens is when you really get into those big sponsor teams, you're dealing with a lot of smart people. And it becomes more sophisticated.
For sure.
They understand the agency money.
Yeah.
They know how it works. And
Absolutely.
so,
but I'm glad you gave us some of the loan requirements because it's important, even if you're passively investing into a
That's
deal, like you want to understand where the sponsors stand as well, so
That's
that
right.
if it's, they're annually looking at, the performance
Yes.
of not only that property, but the performance of that sponsorship team as well.
and as a loan officer, because what happens is you find a lot of these brokers.
Quick question, you
Yeah.
talked a lot about banks, does credit unions not participate? in
Oh,
the
absolutely.
process?
Yeah, they do. I've worked for a credit union before where I did it, yeah. Yeah, but it was interesting, but I think I lost my train of thought.
It's okay.
Yeah, but again, I use Terry as my model, as your sponsor model, just to kind of take you through the whole process that if you're starting with yourself or a partner, at this level, these are the things that banks will look at, for sure.
Well, thank you. I appreciate it. And
Absolutely. Thanks
once
so much,
again,
Terry.
They were great.
yeah.
All right, thank
By
you.
the way, thank you always, Terry. And
Yeah.
it's great to have someone who wants to collaborate with like-minded people.
Absolutely.
To teach you to where to go, where to begin, all these partnerships. And that's what we're all here for, whether it's startup or bigger, we're all here for that. So love to have you back in next year.
Absolutely, yeah,
Start
for
this
sure.
to, really talk about, really deep dive. I try to really deep dive into property management.
Yeah.
There's a lot of important things to look at, whether you're a smaller or a bigger, and what questions you really want to ask in Q&As and what you did. So thank you. What you're doing is phenomenal.
And that's great. I'll tell you, we're Terry, getting back to Terry, I'm using you again, Terry, the bench. As we're doing that loan, we're looking at the property management firm that you're looking at. We look at that contract. Yeah, that's an important, absolutely.
Needs to understand the loan that you're doing.
Yeah,
It needs to be
absolutely.
approved. So there's a lot of strategies within that.
Yes, and CalCap, I'll tell you, I've worked with them for several years. They're
Thank you.
great. Absolutely.
we've had-
You're looking for a property manager? CalCap.
Thank you.
Absolutely.
Not perfect, but we think.
Hey, who is? All right, thank you guys.
No,
Appreciate your time.
thank you.
Hey, if
And-
you guys want one of my cards, I'd be more than happy to give you. Feel
Yeah,
free to
please,
call me
and
with
we'll
questions.
share it too as well, but
Absolutely.
if you have some on
I
you,
do have-
then.
I certainly did.
Absolutely, we'll share with those people online as well.
Yes.
So like I said, we're doing, this is our last meeting of the year. We'll determine in December kind of whether we still have them in person, or we know a lot of people like to join online, but we want to make sure that we have the right balance, and there's always a reason to have, I personally enjoy the in-person touch, but, we can make a determination at the December time. If you guys haven't, I talk about our core values, and why we're doing this, and who we want to be a part of our community, so that when we do have the opportunities, we're kind of going all in with integrity, abundant mindset. You guys have a possibility thinking mindset. We want to see results at the end of the day, right? So a lot of things aren't penciling right now, but we do believe there's going to be a space where that's going to be transitioning within the next 6 months or so, and that you're always willing to continually learn. So as we present, books or conferences and things like that, take a part of it. There's tons of conferences that are in the Arizona market. I mean, like 1 million of them. So there's always an opportunity to learn, and eventually that we'll all go in with the belief and trust after you've built that up over time. So if you guys want to know more, we can always set up a one-on-one time to talk about kind of where you are. Are you kind of wanting to do something more passive? Are you wanting to do something more active? I have folks that are active, and we're looking for that smaller multifamily, and then there's people who just like, I don't want my hands on it. I just want to passively invest, and that works too. So definitely sign up or just reach out to us, and we can always have that conversation. But I appreciate you guys always coming out, and thank you for allowing us this space. Until next time, guys. Please
Happy
definitely
Thanksgiving. Don't eat
pick
too
up some
much turkey.
food on the way too as well.
No, not you.